Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is part 16 of what will end up being a 19-part series covering all the various sectors that are reported on by FactSet. This is kind of one of the more interesting ones I've done, and I'm going to be covering a lot of companies here. I'm going to be covering 16 companies in this sector. But because I'm doing that, I'm only going to spend a few seconds on each one. There's some traits here that I think you'll see that are very common amongst the whole group. And you know what this is really all about is the death of brick and mortar retail exaggerated because of the Amazon effect. And I talk about that in the written portion of this article. But before I go on, if you like these videos and find them worth your while, then please hit the subscribe button right here below the video and become a subscriber so you can take advantage of all the future videos. But let me get into the brick and mortar retailers here, and I want to just make a couple of points. I'm going to start with a simple one. I'm doing these in alphabetical order, by the way. This is AutoNation, which is a retailer of cars. The orange line is earnings per share, as always. The black line is monthly closing stock prices. And a couple of things that you can instantly see when you look at these fast graphs is, first of all, the price follows earnings in the long run. It does get disconnected at times where it gets above the orange line, which is overvalued, below the orange line, which is undervalued, but it always reverts to the mean. And what you're looking at here now is AutoNation, a stock whose price has dropped dramatically. By the way, I find that interesting because we had a really good year last year. Earnings grew by 18% last year, and you can see the stock price followed that from the previous year, but then we're expecting a negative year in earnings for 2019, and we've had this very stark reaction by the market. Now, because I'm covering so many stocks, I'm not going to go much deeper than look real quick at forecasting and just show you what kind of returns this stock would, or these stocks would earn you if they just go back to a 15 PE ratio, which is common for most companies, or a normal PE. In the case of AutoNation, it would be a PE of 14.4. You can see the annualized rates of return highlighted in yellow here at the bottom could be extraordinary. So these companies are really offering some really great opportunities. But again, I want to go quickly now just so I can give you some insights into all the different companies that I'm covering here in the retail trade. So going in alphabetical order, my next company is Best Buy. Once again, you see this earnings and price relationship. We had a loss in earnings in 2012. The company has a January fiscal year. But if I just look at the last 8 or 9 years here, I want you to notice that price has tracked earnings very nicely. The stock got very undervalued as of December of last year, where you had a lot of stocks fall, but has since recovered very nicely. From a forecasting point of view, it's trading slightly above its normal PE ratio, which is lower than 15, but at a 15 PE, this would be a double-digit rate of return potential. It offers a 2.7% dividend yield. Company only has 28% debt, and again, if you look at it more long-term, the company has had some issues where earnings have fallen. It's been a pretty good growth story for most of its history. Moving on now to Big Lots, we once again see this earnings and price relationship. We have a little more cyclicality here, but as I want you to notice, as earnings fell, price fell. The company started paying a dividend in 2015. That's the white line. The area below that is their payout ratio, and this is the dividends after they're paid out. The stock has had 2 really bad years of earnings, fiscal 19, which ended in January, and then the fiscal 20, which will be January of 2020. So we're looking at 2 down years of about 9%, but then we're expecting a slight recovery. You can see the price got excessively cheap going through December of last year, which has been a common theme in these series of articles, but it's now recovering nicely. The market was definitely overselling it. A caveat here from a standpoint of forecasting, 2 down years and then not much growth going forward. So if we look at the longer term 3 to 5 year trend line growth in this example, the analysts are only expecting, there's only one analyst actually expecting about 3% growth. So this is much more of a recovery situation than a growth story. Going on to the next company, we have Capri Holdings Limited. Most of you will know this name, this company better as Michael Kors, the handbag manufacturer that kind of took on Coach. And by the way, Coach has a new name also, and it'll be covered later. But this company came out with some really impressive growth. You can see the growth rates for the first 3 or 4 years, and the stock got hot. But I do want you to notice more recently, we've had very flat growth, or 4.5% growth, and that's why we have the stock price trading as low as it is. The company doesn't pay a dividend. Forecast growth going forward is long-term 5%, shorter term about 8%. We're looking for, the analysts, 17 analysts are looking for a good year in 2020. So this again is another factor where you have great recovery opportunity if the stock moves back into alignment with a normal PE ratio. The company does not have that long a history, but it went from being a really fast grower to a slow grower. And once it became a slow grower, I do want you to notice that there wasn't much going on with the stock price. So this is one of these companies that got real hot at one time and more recently has not been really that great an investment, but it is undervalued today, at least according to its earnings potential. My next company is the drugs chain, CVS. They recently made a big acquisition. I'm going to also be covering Walgreens, Boots Alliance a little later. You're going to see a very similar pattern. I want you to notice how price tracks earnings. I want you to see periods of overvaluation result in poor short-term performance as the stock reverts to the mean. You see that happening over and over. Periods of undervaluation are really great times to buy the stock. I think this stock is excessively cheap right now. If I look at forecasting on this company, it offers almost a 4% dividend yield, 3.7% dividend yield. And if it moves back to a 15 PE, which I see no reason why it shouldn't, the rates of return over the next 2 or 3 years are going to be, on 3 years averaging over 30%. And there's still 11 analysts giving the estimates there. The company has an impeccable analyst scorecard, I might mention. It's always given good guidance to these analysts. So here's a case of a great dividend payer that's extremely cheap, and that's, but it's also growing. I want you to notice this company is growing and is expected to continue growing going forward. My next company is the department chain Nordstrom's, one of the leading, the largest department chain in the country. Look at the price and earnings relationship here. Look how price tracks earnings, but also look how the market tends to overreact. We had a great string of earnings and the market makes the stock very overvalued. Then we come into the recession and of course the stock price collapsed and became excessively undervalued at a PE of 7. Currently trades at a PE of 11.9, has a 3.4% dividend yield. A little bit cyclical. It has actually a better dividend record than it has an earnings record, as you can see here. Stock is really undervalued today. Looking at forecasting, it's estimated to grow at about 6% over the next several years. There's quite a few analysts giving estimates for the next couple of years. So even out to 2021, this could generate almost a 23% annualized rate of return if it were to revert back to the mean. And in the meantime, pays you a nice 3.5% and potentially growing dividend along the way. So you might want to take a look at Nordstrom. If you're going to buy the company with this kind of cyclicality, you want to buy it when it's cheap like it is today. My next research candidate is the food grocery chain Kroger. I'll be covering 2 of those here, one Canadian and one U.S. Once again, we see this strong price to earnings relationship. We see a period where the market gets irrationally exuberant, and then we see this big correction, especially with a little break in the earnings. Once again, we have the stock very cheap. Amazon's been bantering around about, getting into grocers and so on. There's a lot of talk. Kroger is certainly an established grocer, and I think we'll be able to hold their own, and these companies are holding their own. If we look at forecasting, we've got decent growth of 7% on average, 7.5% on average, 4% this year, 9% next year, and 9% the following year. This would lead to really extremely attractive annualized rates of return. And keep in mind, these rates of return are coming not as much, although growth is decent here, but coming from the fact that these stocks is tremendously undervalued. This company is available at a PE of 12 with a dividend yield of 2.2%. My next research candidate here is the smaller department store Kohls. And I do want you to notice, again, the earnings and price relationship. Look what happens when a stock gets overvalued like Kohl's was. It was a very popular stock. This is even back in the recession. We went all these years with very little performance. The company starts paying a dividend in 2012. The dividend has grown beautifully. If you look at it from the growth of the dividend, it's averaged 14% a year. If you look at the company from just, really covering the period since it's been paying a dividend, go back far enough here, then you're going to see that it was undervalued and it's moderately reasonably valued today. Performance now is much better, still underperformed the S&P, but it did generate more dividend income. The company offers a 3.8% dividend yield and is moderately undervalued. Forecasts going forward are some what I'll call, below average growth of about 4%. But again, if we get a reversion back to this 15 PE, like it was trading here, we've got double-digit rates of return. This might be my least favorite in this group, but it's certainly one that is worth taking a look at. My next research candidate will be the retailer Macy's. Now, Macy's is kind of an interesting story in that, we see a lot of cyclicality historically. We see this relationship between price and earnings. How well the business does is how well the investor is going to do over the long run. But again, it's always better to buy these stocks when they're cheap than when they're expensive. But even if you buy them when they're cheap, if you're buying them in the face of dropping earnings, you could still do very poorly over time. This company is forecast to continue to have weak earnings growth. It's offering a current 6% dividend yield. I might mention the company has cash flows, both free and operating cash flows, to support that yield. But the real risk here is whether or not the stock is going to, continue to go down. Even the long-term growth rate is much better at about 4.5%. So if I combine the custom growth rate, which is the estimate tab, with the 3 to 5 year trend line, this company still could generate very attractive rates of return with a 6% dividend yield that is pretty well covered. It hasn't been growing at all in the last 4 or 5 years. I do want you to notice that they've been flat, but it is a high-yielding stock at a very low valuation. The PE is only 6. The company has 42% debt, and it is an iconic retailer. But again, beware of the dropping earnings in this case. My next retailer is Target. Everyone knows who Target is. You see a very clear earnings and price relationship. The stock got real cheap through last December. It's now back into fair value, I would call it. Offers a 3.1% dividend yield. It's expected to grow at about 5.5% long term. Over the next couple of years, about 7 to 8%. This, again, gives the opportunity for nice 10, 11% returns. It's A-rated, trades at under 15 times earnings, offers a 3.1% dividend yield. I think Target is a solid buy here, and I do want you to notice that they've been competing favorably against Amazon as far as keeping their growth and their earnings up. And I might take a quick look at price to sales. Their sales have been doing decently as well. Going on, my next research candidate is Tapestry, better known as Coach. This company currently has 3 primary brands that are important. They have, of course, Coach, which is what they built their brand, their company on, and then Kate Spade, and then Stuart Weitzman. And, it's a really good retailer of women's fashions, etc. The company did have some earnings issues coming into the 2013, 14, 15 era. They kind of redesigned their business. It offers a 4% dividend yield. It's very undervalued. The company has maintained the flat dividend for the last 3 or 4 years, and the forecasts are it's expected to continue with a flat dividend. But it does present a very interesting opportunity with a 12.5% PE, a 4% dividend yield, BBB minus rating, and only 31% debt. Again, this company could lead to very strong, even out 3 years, over 20% annualized rates of return. This is the old Coach. My next research candidate is actually a Chinese company, VipShop Holdings, does a lot of online sales. This is a very interesting one to show because it's a case of, with Amazon doing what they did, the company came out with some tremendous growth the first 3 or 4 years here. When they went public, the price got way ahead of that growth, astronomical PE ratios into 2015. And even though the companies continued to grow over these years, I want you to notice the price came back into alignment with fair value as represented by the orange line. Then we had a nice pop in 2018 before the quarters start coming in, indicating they were going to have a down year, and the price has collapsed. Going forward, the company is expected to grow at a double-digit rate of 13%. It pays no dividends, available at a 13 PE, so this is a pure growth opportunity that could generate double-digit rates of return going forward. The analyst scorecard, I might point out, is not so hot here. So this is just one I just really wanted to show because it really shows how dangerous high valuation can be, and that's something I talk about quite often. My next retailer is a Canadian company, Canadian Tire. It's a specialty stores company. This is really a very, very classic example of the type of company that I like to invest in for total return. Very consistent operating results. Little bit of a hiccup during the Great Recession, I guess you'd say, but you could see how prices tracked earnings, only trading at a 12 PE, very cheap relative to historical norms, offers a 2.8% dividend yield, BBB plus rating, only 4% debt. The company's long-term rate of return has been exceptional, certainly has kept up with the stock market, keeping in mind that the stock market is having some of the best, times it's ever had. But I really like this company. I don't own it, but I like it. It's the kind of company I like. Consistent operating results and a very attractive valuation. My next research candidate is the second grocery store that I covered. I said one American, one Canadian. This is the Canadian food retailer. I guess that's Loblaw or Loblaw. I'm not really sure how to pronounce the name. Once again, you see a perfect correlation between earnings and market price. You have short periods of time where you get disconnections. The stock is reasonably valued at a 14.6 PE, 1.8% dividend yield, BBB rated by Standard & Poor's, only has 30% debt. Forecasts are for relatively low growth over the next couple of years, relatively low growth long term. I might point out, and the same would be true with Kroger that I covered on the U.S. side, grocery stores tend to have very low margins, but they also have very consistent businesses. Anyway, this is the Canadian Loblaw or Loblaw. I'm not sure how to pronounce the name again. My next research candidate is Weston George Limited, another Canadian food retailer. Once again, you see a very similar record, pretty decent dividend record, 2% dividend yield, BBB rating, 55% debt. Again, this is just really an example of how price tracks earnings. It's reasonably valued, but not necessarily excessively cheap. And then last but not least, I'm going to go into the retailer Walgreens Boots Alliance. And very similar to what we saw with CVS, we see an extremely low valuation, even though earnings are holding up and the dividend is continuing to grow. I really like showing this stock because I think it really shows how critical valuation is. We had very high valuations from 2000 all the way into the Great Recession, and there was literally no performance in this stock over this time frame. I'm just picking arbitrarily times here. You literally had moderately negative rates of return here, but this is a time. Look at the growth rate of the company's earnings over this time frame. Double digit all those years. You can overpay for even the best companies. In contrast, the company's very cheap now. PE ratio is only 9. Blended PE is 9. Dividend yield 3.2. BBB rated with 29% debt. Anyway, the retail sector's got a lot of value in it. These are 16 examples of widely recognized, well-known retailers that are certainly inexpensive today. So, I think it's important to recognize that the valuation, I believe, gives the opportunity to compensate you for the risk you might take in investing in retailers in the face of Amazon. Anyway, I hope you enjoyed this presentation. This is Chuck Carnival saying talk to you soon. Thanks for watching.